Good morning, everyone. Welcome. Now, I know when you see a topic like lease accounting on the syllabus, it might seem, well, a little dry, a bit technical. But what I want to show you today is that for you, as future managers, as future decision makers, understanding lease accounting isn't just about crunching numbers. It's about strategy. It's a powerful tool that affects how your company is perceived, how it's valued, and how it manages risk. So let's dive in and unpack the massive impact these decisions have on a company's financial story.
Okay, let's start with a scenario. I want you to put yourselves in the CEO's chair for a minute. Your operations chief comes to you and she's got a rock-solid case. To keep up with demand, to really grow the business, you absolutely need a new piece of machinery. The problem? It costs $1 million. You check the company's bank account and you've only got $50,000 in cash. So what do? This isn't just a textbook problem. This is a situation businesses face every single day. And for a huge number of them, the smartest move isn't to buy it, it's to lease. So here's our roadmap for today. We're going to start with why leasing is such a big strategic decision in the first place. Then we'll get into the nitty-gritty of the two main types, operating and finance leases. After that, we'll look at a real-world example of how this choice can completely change a company's financial statements. We'll see how outsiders like banks and investors look at this. And finally, we'll wrap up by going over the most common mistakes people make so you don't fall into the same traps.
All right, let's get right into it. The strategic decision. When a company decides it needs an asset, a fleet of delivery trucks, a new corporate headquarters, or that $1 million machine we just talked about, the decision to lease isn't just about getting the asset. It's a fundamental choice about how to use capital, how to manage risk, and frankly, how you tell your company's story to the financial world.
Now, before we go any further, let's make sure we're all on the same page with our vocabulary. The formal definition of a lease is pretty straightforward. You've got the lessor, that's the person or company that legally owns the asset, and you've got the lessee, that's you, the company getting to use the asset. In exchange for using it, you make regular payments for a set amount of time. Simple enough, right? But I want to warn you, don't let that simplicity fool you. The entire world of lease accounting exists to figure out the true economic reality hiding behind this simple contract. That's where the real analysis begins.
And this right here, this slide gets to the absolute heart of modern accounting. It's a principle we call substance over form. What that means is we don't really care what the legal document is called. It could say rental agreement in giant letters at the top. Accounting rules force us to look past the legal form and get to the economic substance of the deal. The single most important question you have to ask is, who is really acting like the owner here? Who gets the benefits if this asset works great? And more importantly, who's on the hook if it breaks down, becomes obsolete, or just isn't useful anymore? Answering that one question correctly is the key to unlocking everything else.
So, that big question about who really owns the asset? Well, it leads us directly to the two main ways we classify leases. I want you to think of them as two completely different paths you can go down, and each path tells a very different story about your company's finances.
First up, we have the operating lease. The easiest way to think about this is like a true, genuine rental. Let's say your company leases office space for 3 years. You use the space, but the landlord, the lessor, is still responsible for the building, the big repairs, all of it. You're just using it for a small piece of the building's total life. Now here's the crucial part, and this is a huge change from the old days. It used to be that these leases were off balance sheet. They were hidden. Not anymore. Under the new rules, even an operating lease requires you to put an asset and a liability on your balance sheet. The idea of off-balance sheet financing through operating leases is pretty much dead. The real difference today is in how the expense shows up on the income statement.
And then we have the other path, the finance lease. You might also hear it called by its old name, a capital lease. Now, this is not a rental. It's really a purchase in disguise. It's a way of financing an asset. If your lease is for, say, 90% of the asset's useful life, or if the payments you're making are almost equal to the full price of the asset, well, you're effectively the owner. And the accounting reflects that reality. We treat it exactly as if you went out, bought the asset, and took out a loan from the bank to pay for it.
So let's boil this all down to one simple idea. When you're looking at a lease agreement, this is the mental model I want you to use. Just ask yourself, who is the de facto owner? Who's acting like the owner? If all the signs point to the lessor, the person who legally owns it, still having all the risks and rewards, then you're looking at an operating lease. It's just renting. But if it's clear that the lessee, your company, has taken on those risks and rewards, then for all intents and purposes, you're buying it. And that means it has to be a finance lease. Internalize this question. It is the key.
Okay, enough with the theory. Let's make this real. To see just how much this all matters, we're going to look at a little case study. A tale of two companies. Now, these companies are identical in every single way, except for this one accounting choice. And as you're about to see, that one choice will paint two totally different pictures for anyone looking at their financials.
Okay, so meet our companies, Innovate Inc. and Build Co. Operationally, they are perfect clones. Same products, same customers, same cash flow. And they've both just started using that exact same $1 million machine. The only difference is that some tiny details in their contracts mean that Innovate's lease is classified as a finance lease, while Build's is classified as an operating lease. Let's see what happens to their financial statements on day one.
And here is the punchline. Look at Innovate Inc. with the finance lease. Their balance sheet just got a lot bigger, what we call grossing up. They immediately record a $1 million asset, their right to use the machine, and a matching $1 million liability, which is their obligation to make payments. Now look at BuildCo. This slide shows the old way of doing things, where this was completely invisible, off the books. But remember what I said about the new rules. Today, BuildCo would also have to record a right-of-use asset and a lease liability. The number might be slightly different, but it would be there. So the real difference isn't on the balance sheet anymore. It's on the income statement. For Innovate, they'll show two expenses, depreciation and interest. For BuildCo, they'll just show one single line item called lease expense, and that changes everything for key performance metrics.
So why does this matter so much? Who cares how the expense is classified? Well, you have to remember that your financial statements aren't just for you. They're the story you tell the outside world, to investors looking to buy your stock, to banks deciding whether to give you a loan. And they are making huge decisions based on the story you're telling.
Let's look at one of the most common metrics out there, the debt-to-asset ratio. It's a quick and dirty way to see how leveraged a company is. Now, with the new rules, both companies will see their assets and liabilities go up. But a finance lease liability is almost always treated as straight-up debt by analysts. The operating lease liability, sometimes it's included, sometimes it's not by data providers. So a less experienced analyst might look at these two companies and think, wow, Innovate Inc. is loaded with debt, while BuildCo looks much safer. They might completely miss the fact that both companies have the exact same economic promise to make those $1 million in payment.
Let's play this out. Imagine I'm a loan officer at a bank, and your applications from Innovate and BuildCo land on my desk. I pull up the numbers, I see Innovate's financials, and that $1 million liability jumps right out at me. I plug it into my model, and their debt ratios look high. Then I look at BuildCo. I see a similar liability, but it's labeled differently. If I'm not careful, if I'm not a really sharp analyst, I might just say, BuildCo looks cleaner, they're the safer bet. But a good analyst, the kind of analyst I want you to be, would dig deeper. They would look at the footnotes, understand the true cash obligations for both companies, and adjust the numbers to make them truly comparable. Your job as a manager and an analyst is to see through the accounting to the reality underneath. This is exactly why this stuff matters so much.
Okay, this brings us to our last section, and it might be the most important one. Let's pull everything we've learned together by looking at the most common mistakes that students and, honestly, a lot of professionals make when they're looking at leases.
Let's break these down because avoiding these pitfalls is what separates the pros from the amateurs. First, and I can't say this enough, the idea that operating leases are off balance sheet is ancient history. It's wrong. Under ASC 842 and IFRS 16, nearly all leases have to be on the balance sheet, period. The key difference now is how it affects things like EBITDA, because a finance lease's interest expense is non-operating, while the entire operating lease expense is an operating cost. Second, ignoring the footnotes. That's like trying to read a book by only looking at the cover. The footnotes are where the real story is. That's where you find the assumptions, the future payment schedules, the discount rates, all the information you need to build a proper financial model. Third, comparing companies without adjusting for their leases is just bad analysis. If you're comparing an airline that owns its planes to one that leases them all, you have to make adjustments to get a true apples-to-apples comparison. And finally, never ever forget about cash. The accounting can be complicated, but at the end of the day, both Innovate and BuildCo have to write a check to pay their rent. And how that cash outflow is classified on the statement of cash flows is also different between the two lease types, which can really change your analysis of a company's financial health.
So I'll leave you with this final thought. The next time you open a company's annual report, after you glance at the big three statements, where are you going to go to find the real story, to uncover the commitments and obligations that might not be obvious at first glance? The answer, I hope you now know, is in the footnotes. It's in the lease disclosures. Knowing that those obligations are there and knowing how to interpret them is what will make you a truly insightful, strategic decision maker and not just another number cruncher.